It's Friday. All right. This is the best time of week, Chris, where we get to wrap up the markets. Another interesting one. We didn't end up in all-out war in the Middle East this week, so I think we can celebrate that as good news. We saw the market go higher. It's very clear there is a wall of money and stimulus from just about every government in the world stimulating the economy and the markets right now. It's pretty hard to imagine any other outcome than the market's going higher, given that one fact alone. I think if we've learned anything over the last 3 years, Chris, is that nothing matters more than stimulus. That is the 800-pound gorilla on the markets. Wouldn't you agree?
Absolutely. Liquidity is the most important factor. Global liquidity.
That is. So we're going to talk all about liquidity when we come back and how everything else has not worked except for following liquidity, which is, I guess, somewhat newsworthy. And we'll be right back after this. All right. So for those who don't know, what is liquidity, Chris?
Liquidity is fancy word for money being pumped into the system. Basically, how readily available is cash, and that has different ways of coming into the system. You know, it could be direct stimulus checks like we saw during COVID. It could be in the form of loans, whether that's the PPP loans being forgiven, but also just credit in general being more readily available. So liquidity comes into the system from a lot of different ways. It comes in from different areas around the world. It's not just the U.S. We saw, I think it was 2 weeks ago, that China announced that they were going to start supporting their markets with some stimulus and liquidity to they trying to get the lending market going again in China, and that market took off as well. So, and like you said, in the short term, at least, it has been the most important factor by a long shot. I think it was the famous Marty Zweig who said something to the effect of, "Don't ever fight the Fed," right? And could be wrong, could be right, but it's definitely seems to be ringing true these days.
Yeah, well, and I would say over the last 3 years, with everything that's gone on, from COVID to recovery from COVID to insane inflation, et cetera, at the end of the day, I guess the moral of the story just came back to how much fiscal and monetary stimulus was coming into the market, certainly here in the U.S. and certainly abroad as well. So this is, I think, ties real well into the cartoon here from Hedgeye. And that seems to be what's happening. I guess you just have to wonder at some point, does the party come to an end, right? Like if it's just one sugar high after another sugar high, and can the government just stimulate until forever? I don't know, right? I mean, that's the great question.
Well, so far there hasn't seemed to have been too many consequences other than, of course, the inflation that got out of hand briefly. But speaking of rates, as of today, just last week and most of this week, actually, there's about a 50-50 shot between a quarter point drop in rates at the next meeting in November, right after the election on the 7th, or a half a point. So a quarter point to a half a point drop. Now we're at nearly 93% probability of a quarter point. And then there's a 6%, a little over 6% probability of no cut at the next meeting. So, talk about expectations being thrown off. But, this is another thing that if somebody went back and told you this stat, this is crazy. Nearly half of the S&P 500 by market cap, meaning like what's the market capitalization, or what is the market value these companies at. Nearly half of the S&P 500 by market cap is currently under government antitrust scrutiny. And yet seems to keep chugging along, right? So
Well, they haven't added Visa to this one yet, though, so it must be more than that. Oh no, there it is. Sorry,
it's on there. Yep.
The
Visa's on
Visa
there.
one's classic, right? Where you get Nancy Pelosi like a week before the investigation opens up by DOJ, like magically her husband sold all their stock.
Mm-hmm.
I mean, for real, like it's just crazy, blunt, obvious at this point.
So a lot of people have been wrong. A lot of very smart people have been wrong. This chart was from September of 23. So September 29th of 23. So almost exactly a year ago today. And this was from Bank of America's Ian Hartnett 1 year ago. He said central banks likely ain't finished breaking stuff. Stay bearish and defensive and sell the last hike. And in brackets here, I'm not sure who added this, but it says since then the S&P is up 33.1%. So there's just been we were talking before the call, all the economic indicators, whether you're talking the yield curve, you're talking the Sahm rule, you're talking unemployment rates, all these things, they've all been wrong. They've all been wrong so far. Knock on wood, right? Knock on glass table. So investing is hard. Nobody knows what the future holds. Be prepared for anything. And the spectrum of probabilities are really endless in terms of what the result can be moving forward.
Well, I think part of the issue, though, Chris, is that when you think about markets, we have a black and white sense of it, right? Like there's a right, there's a wrong. And that's really just the wrong way to think when you think about markets. Mm-hmm. The only appropriate way to think about markets is through a lens of probability, right? Like there's no rule that's always right. There's a probability it might be right, but there's no one that can make the argument to me that these markets are going to do exactly what they've done in the past, given all of the influencing factors going into the markets now, right? I mean, you've got the fiscal deficit we're running now. Our debt in our country is increasing at a very rapid rate, dangerously so, perhaps. And you've got I would say, a very active Fed, a very active set of central bankers from around the world. And that's not historically been the case. So things have really changed. And I think that presents a even more delicate process for investors to try and understand, like, well, what should I do then? If none of these rules that have played out are playing out, what do I do now? And that's why you have to stick to, a set of timeless principles or processes.
Yep. Or you just believe that the Fed or central banks around the world are going to bail it out every time. And there's a safety net under the market that hadn't existed before. I personally feel like that's pretty, sketchy to believe that, but I can see how people would believe it after what we've been through over the last decade plus. So sentiment this week moved down slightly, but still elevated from AAII, and the CNN Fear and Greed Index is still set at greed 71, pretty much unchanged from last week. Bitcoin swung pretty dramatically from 61 greed last week down to 41 fear this week. So not sure exactly what's going on there, but Bitcoin's like your manic, crazy uncle, right? You just never know if it's up or down. Changes week to week. So we've got a series of charts here, and we can go through these kind of quickly. It's basically saying the same thing on all three charts, but from Bespoke, he says, Bespoke Investment says, here's a look at our global central bank rate monitor, which highlights the easing we're seeing around the world. So they're consistently falling after a long time of increasing. And if you go to the next chart, you'll see September of 24 was the biggest month of monetary easing since April of 20, which was COVID. Now, granted, it's not the scale that we saw during COVID, but still significant. And so, you can see back to great financial crisis. So going back to the pattern that we've seen from the central banks, is that they've supported the markets through all these different issues, really since the great financial crisis. And what we saw in September is on par with some of the liquidity that was injected in great financial crisis times. And then this last one is from Cross Border Capital. They're kind of famous, I think, at least from what I've picked up on, telling people about this theory that, look, there's this cycle in global liquidity. That's what really drives asset prices. Pay attention to that, because I remember them saying a year ago, hey, there's an uptick in this liquidity. The cycle's starting. We're bullish risk assets because of it. Do you seem to remember the same thing, Daren?
I do, yeah, because they came. Well, maybe they've been on the scene for a while, but I started hearing them not maybe about a year ago, and that was kind of their argument, that when liquidity kicks up in that cycle, you don't bet against it, you just follow it. And we're certainly seeing that now, right?
Yep. So what is all that liquidity provided so far? Well, if we go to the next slide, we see that S&P is heading for its best year so far since 97. That was pre-internet bubble, year to date. So the market's responding positively to that liquidity. Now, think back to 22 when the opposite was happening, when liquidity was being pulled out of the market globally. Central banks around the world were hiking in response to elevated inflation rates. And so they were in a coordinated hiking cycle instead of a liquidity cycle. And assets everywhere got pummeled, basically. Stocks, bonds, just everything lost at the same time, with interest rates going up, money getting tighter, the liquidity being pulled out of the system. We have two very good recent examples of these liquidity changes. And I think when you go to the next chart, the other sign of this is that we're seeing the rally broaden amongst the S&P. We've been talking about that a lot over the last few months, where it's no longer as concentrated as it was to begin the year, and much of what we saw in 23. But now it's starting to broaden out across the stock market, across the size. So small, medium, and large are benefiting more equally, whereas we were just seeing the large stocks really, and just within the large stocks, just a handful of those large stocks were providing all the returns. Now, if you are someone that watches economic data, knows economic history, it's really been a hindrance and not a help. And I think it's important to keep in mind that I think Annie Duke, she's kind of a famous decision making expert. She's a famous poker player, and she talks a lot about how you can have the right inputs and have the wrong results, even with the right inputs. And I think it's, I don't know, maybe constructive to think about the fact that, hey, if you look at all of these indicators that had always worked in the past, literally, pretty much every one of them has been wrong. And so if you are someone who is a risk manager, or you're taking a look at probabilities of outcomes that could happen, in order for you to have had the best outcome in this situation, you would have had to say all of these signals are wrong, right? And I think that's where when you look at a lot of these experts that were calling for a recession over the last couple of years, were wrong, but they were wrong for the right reasons, if that makes any sense. Because when you do look at the inputs, this is the first time that I know of that they've pretty much all been wrong across the board. So lucky for those that have called it. But this is another one, the Sahm rule. This is the yield curve inversion, which we talk about a lot. This is the longest yield curve inversion in history without a recession. We've got the Sahm rule versus claims. The Sahm rule has never been triggered with claims as low as they currently are, even when the labor force was much smaller. So, over and over, you're seeing these situations that just haven't happened before. And maybe a lot of that is because of this liquidity. It's one of the first times that I know of where we've been pro-cyclical with it, injecting all this liquidity with unemployment low, with growth, fairly strong. Basically, usually the government and the central banks react to the economy counter-cyclically, meaning when kind of things are going poorly, that's when they turn on the fire hose. But right now they're flooding the market with money when nothing is really going haywire. So maybe that's what's causing all of these indicators to be thrown off. So speaking of indicators and stimulus, this is from macro charts showing that China's Hang Seng index has triggered its strongest breadth advance. So meaning that the number of stocks above its 10-day advanced decline line, the strongest one in history, which has been a classic bull market initiation signal. This is another one. I distinctly remember last fall, the word uninvestable being thrown around about China. Remember, everybody was
totally
so bearish on China. It's uninvestable. That was literally the word. And boy, has that been wrong.
But that's the thing, dude. It's not even about whether or not that company's actually investable in. It's purely about what's the stimulus coming into the market, and is there going to be liquidity, because the liquidity covers all sins, and that's the reality.
Yep. Well, and the fundamentals do look better. So this is from Meb Faber showing the CAPE ratios for China and India back when they were the hottest thing to be in the early 2000s, going into the great financial crisis. Their CAPE ratio, which stands for cyclically adjusted price to earnings, so it smooths out the price to earnings ratio over a 10-year period to kind of give you more of a clearer picture, is the expectation. And so China hit 55 and India hit 49 back then. And everybody knows really since 2007, the Chinese stock market's gone nowhere. It's gone up and down, but it has not advanced since then. And that's pretty classic when markets hit fundamental thresholds that are just kind of way out of the norm in terms of the valuations just get sky high. You're susceptible to lost decades or more. In the case of Japan, it was 30 plus years. So I would say, yes, watch liquidity, watch stimulus, but also take a look at those underlying fundamentals and realize, is it the beginning of the party or the end of the party? Like, did they just bring the booze out, or is it late in the night and it's starting to get out of control, right? I think that's where you want to kind of keep an eye on it. So I thought this was very interesting from Bank of America. And their quote here is that retail, which is, I guess, what they call basically, mom and pop investors, anybody that's not a large institution like a pension or a hedge fund, that type of investor. So retail has missed the gold rally for the first time since GLD's inception. GLD is a common ETF, maybe the most popular ETF for gold. And they say we're tracking 25 billion of physical gold ETF outflows since buying peaked in October of 2020. And so you see the gold price there on the dark line. Gold's been hitting all-time highs pretty much daily. And then you've got the outflows from the investor base, which is interesting. I'm very surprised, but also makes me kind of wonder about the gold market because you're not really hearing. Very few people ask about it. You don't hear, you don't go to parties and people aren't talking about it. So it's kind of quietly hitting these all-time highs and doing well. So we'll see how long that lasts.
Well, as long as the central banks keep buying, right, and that's what clearly is driving a lot of this gold price, then it's pretty hard to argue that you're going to see anything other than continued price movement. Maybe not up as fast, but certainly there's a lot of support. And I think given the last week and just the stuff going on in the Middle East, the things just keep piling up from a geopolitical standpoint that suggests that gold will continue going up.
Yeah. So Liz Ann Saunders talking about Redfin data here. U.S. home buyers need to earn just shy of $77,000 per year to afford a median priced starter home, $250,000, which is down by 0.4% year over year. That's the first annual decline since August of 2020 for Redfin. So finally starting to see a little relief on that front. Now, what's been very curious or confusing, depending on how you look at it, is that interest rates were going down into the Fed meeting in expectations of rates getting cut. Since they announced the cut, interest rates have been going up. And I have had more than one person say, what in the world? How are rates going up now? So it's kind of a conundrum. Like, what is the private market saying with that? Like, because we talked a lot about how the private market was going down while the Fed was holding the rates high in kind of a way of saying like, hey, you guys need to cut rates. You're too tight. And now with the rates spiking here recently, interesting. Like what is the private market saying? Is it just a blip on the radar and that's going to turn back down to the downtrend? Or are we going to kind of change directions and start getting increasing rates in the private market while the Fed's lowering rates? That'll be a fun one.
All right, let's dive in and take a look at the markets. How we closed up this week. We'll start with the S&P like we always do, pretty much. Pretty decent week overall. We lost some ground midweek, but today certainly went up. The jobs data came out today, and there was quite a surprise in the non-farm employment change. They expected 147, and it was actually 254. The thing that always annoys me about the job data is it's extremely noisy, though, right? It comes out and the market moves off of it, and then 2 months later, a month later, they're like, oh yeah, by the way, there was 100,000 less jobs than we thought. But how the market puts that it takes that into account is interesting. So your S&P 500, we didn't finish at an all-time high. I guess you did. We did for the weekly chart. We finished at an all-time high on a weekly candlestick this week. We didn't make the all-time high, but we closed up the market at an all-time high. So pretty hard to say anything other than that's bullish. And going back to what we talked about at the start of the program, there's just so much liquidity coming into the markets. Pretty hard to bet against this. Additionally, there were people betting against this. And when jobs data comes out all of a sudden, and it's better than expected, the economy's stronger, people go, oh, oops, maybe I shouldn't short the market. And that squeezes the market, we call it a short squeeze, and pushes it higher. And the fact that we closed up at 57,572, we definitely squeezed higher. So we continue to climb, and that's a bullish candlestick. And I think going into next week, I would expect that given the news from today. That obviously fed also into the crypto markets, which are the front end of the risk curve. It was a down week overall, but I wouldn't say that I'm particularly concerned about that chart. It just looks like consolidation. And Nvidia continues to rock and roll, but I think I'll point out, Chris, and Nvidia did its been doing well the last 3-4 weeks, but now we're broke out above this trend line and closed above that trend line. And I think that's very pronounced. And I think we need to pay attention to that. I don't really like to say it because I'm kind of tired of watching Nvidia win, but it looks like they're going to continue winning. This is what's called a doji candlestick, where it's really compressed in the middle. It means the buyers and the sellers are kind of still debating on where it's headed next. It can usually be a topping or a bottoming candle. But the fact that it closed above this trend line for the week, I think you have to take that as bullish on its face. Microsoft, interesting, with all the other big seven, they're doing pretty well, but Microsoft continues to show weakness. So I think that's interesting. I think your point earlier about the market getting more depth to it is well taken, Chris. The oil markets, with all the hubbub over in the Middle East, we've seen oil markets go higher. What's interesting, though, when we've been talking about this consolidating triangle here for a few weeks, and the fact that we broke below, and then now we came up to the bottom of this trend line, which is, I would call that resistance now, and it got sold off there. So basically got sold off below 75. This could be a rejection because this is looks like a completion of a double bottom we talked about last week. Extended up, got resistance here. That's the move. So it could actually be down for oil. So, one scenario is this jobs data is, I don't want to say fake, but not accurate. And then the market takes that into account later, and we actually are headed more towards a recession. The fact that everybody's just given up on all these like indicators that have, the yield curve inverting, and that leads to recession, the Sahm rule, all those, almost makes me feel like, oh, well, if everybody's completely given up on those things, it's probably going to come true now. But
yeah, exactly. As soon as everybody goes, oh, nothing to worry about.
Yeah. Now the 10-year is interesting. It had quite a candle today, right? So when the jobs data came out, the rates just went higher, right? And so maybe the market's saying, whoa, we got that wrong. Albeit this is, I would say, resistance, this line here right around 3.98. In fact, it closed right below that. The move's done, and then it could reverse. I could see that kind of story happening here. I think, any way you look at it, you have to say at least the medium term rates the trend is lower. This would be the trend line that I would say, oh, rates are headed higher. So if we break above 4, hold 4.1-ish, then I'm going to say rates are going to start going higher. But we've still got some blue sky to get into before that's the case right in this area. So next week, if we see something like that in a breakout, then maybe we say rates are headed higher. But right now, it still has to contend with that resistance zone. So I wouldn't take the victory lap yet. Not a good day for bonds because of interest rates, just kind of shocking higher. But that goes nature of the beast, right? All right, let's see. What else do we want to look at today? Oh, I thought that was interesting, Chris, your point earlier, we're talking the number, like, tell everyone that point you said about, and this isn't to get political, but I think just really fascinating. So what was the number one performing asset class during the Trump administration, or the lowest performing asset class during the Trump
administration? Sector of the S&P, right? And gosh, let me think of who I heard this from so that I can credit them, because it was such a mind-blowing stat. But so the lowest performing sector under President Trump was the energy sector. And the highest performing sector under President Biden has also been the energy sector.
Like,
so
what are the chances of that?
Is that policy related? Is that just a cycle? Like where the sector does horribly and then it does great? I don't know. But I think it's one of those things that you would just, on its face, you would never guess, right?
Yeah. But that just goes to say, like, if you're trying to predict markets because of who's going to win or not win 32 days from now, it's a fool's errand. Like, it's not something you're going to be successful to try to not invest. It's better just to stay with your principles, stay the course. Anyway, that's an interesting stat. Well, so I think we're going to leave it there, Chris. I think it was an interesting week. Markets moved higher generally. I think the jobs data was interesting, surprising, but I don't trust it, I have to say. I'm waiting for it to be revised. But they continue to pace higher. I will note the only thing kind of on the S&P, you'll see this long-term trend line I got on the SPX. And you can see the market actually didn't break above that long-term trend, so it's still acting as resistance. But it seems to be like it's working and building higher. So anyway, we'll see what happens the rest of October. We're 4 days in, and so far, so good. It's usually been a very volatile month during presidential elections, and I can't imagine that this election is going to be any different. But who knows, and we will see. As always, we'll wrap up the markets on Friday. Take care, everybody. Have a wonderful weekend. Bye for now.